Alright, so I wanted to take a few minutes and really kind of discuss advantages to trading small. And what I mean by trading small is having the ability to, I want to say manipulate what you're doing. And what I mean by that is, there's probably a better word than manipulate, but scaling out, you know. So let me just kind of give an example of kind of what I'm talking about. You know, I think the biggest problem for most people is, they study Al and they know the E-mini is a great market and they want to trade it. But the problem is that most people starting out really don't want to trade more than one contract. And when they do trade more than one contract, first off, one contract is in reference to futures markets. There's not shares in futures markets. Futures markets deal in contracts, and one E-mini contract. If you risk 1 point in the E-mini, that's $50 per contract. So you risk 4 points. In other words, if you bought this close and put your stop down here, this is the spider, but that's going to give you, that would be somewhere around, sorry, I'm missing something here. It's about 60 cents, so that's close to about 6 points. So that's about $300 risk for one contract. And I think the problem with most traders is that, they go in, they have the right plan, but they're not honestly willing to do, they have the right plan, but they're not honestly willing to use the right stop. And, I guess a similar approach would be, traders are, they'll sell this close, or they'll sell down here, and instead of using the stop that's appropriate, which is up here, they do something in the middle and they get stopped out. So, let me kind of walk through this day in two parts. First, this is the spider chart, and let's assume it's an E-mini chart, because if I flip to an E-mini chart on the November the 8th, it's going to look the exact same as this, so there's just no need for that. So let's pretend we're trading the E-mini and we're starting out. Well, the problem is I've only got one contract, and I think, let me add one more thing to that. And this video is going to have to do with swing trading and how I would scale out of positions, or what I would do. I think one problem, if you miss a lot of big moves, one issue is risk. You see the market going up. You know that, wow, that's a big gap. You know that when you look at this, I'm going to have to do it like this just so it's easier to see. But when you see a big breakup bar and follow through, if you buy and put your stop down here, you'll make money. You almost always will. The probability is really high. However, most people won't do that because of the risk, It's the same right here. Traders know if they sell anywhere up here and put their stop up here, guess what? They'll probably make money. But they don't want to do that because the risk is too big. So what do? They do something in between. And, it causes them to lose. Al had a great a webinar over that the other day, which you can find on the Brooks trading course. And also he'll release it's part of his new trading course. But anyways, if I'm trading one E-mini contract, what do I do? Maybe I buy somewhere in here, put my stop down here. And, the problem with just trading one contract is risk. If I'm long right here and my stop's down here, that's going to be let me just do it this way. It's going to be a lot easier if I go to the actual E-mini chart than trying to convert it. If I'm long right here and stop down here, that's 17. That's about 5 points risk. That's $250 a contract. Well, if I'm starting out, I probably don't want to even risk that. Second, there's no way for me to, keep my risk the same. So if I'm long, sure, you can do that. You can always you buy at the market, you hold long, you get out below here. Hard to do when you're starting out. So if we go to the spider, same day, let's say we're trading the spider and we're trading, our max positions 200 shares or even 100 shares. Let's just say 100 shares. Well, let's keep it simple. Let's say we don't want to do anything in here. Full breakout. Okay, I'm going to buy the market. Put my stop down here. And I'm going to risk, 100 shares. Well, and then we get another follow through. And I say, okay, my stop now is down here. It's basically, I've got a very high probability of price going to measure move up before it stops me out. I'm going to buy another 100 shares. So now we're at 200 shares. We bought here, and our stop's down here. And let's say, we say, okay, I know there's a really high probability that we'll get a measured move up based on this open and this close, taking you up here. So what I'm going to do is I'm going to take my first position of 100 shares, which is buying this close. I'm going to get out at this measured move target. And I'm going to trail the second 100. So over here, we scalp out half, and price goes up to here. Now our stop's down here. Well, if you're quick, you would say, okay, bear breakout bar. The bears probably need one more bar. I'm going to buy at the market, buy back my original 100 shares, put it down here. Now I'm back to a full position, and maybe I'll scalp out the other 100 up here. But ignore that. Let's pretend you don't do that. Then maybe you get out of your, your last remaining position here. Well, look what that allowed you to do. That allowed you to not only, for one, it allowed you to trade very comfortably, and you did not have to worry about the risk. And if 100 shares seems like too much, trade 50 shares. But regardless, it allowed you to take part off, take another part off, and lock in profit instead of, doing what a lot of people do when they're starting out. I've done it. I'm sure everyone's done it at one time or another. You buy the breakout and use the wrong stop. Let me find an example. Really none of it here, maybe. That's kind of one. Well, not really. Yeah, anyways. You get what I'm talking about. And here's another day. Huge sell-off. If you're trading one contract, then on the E-mini, it's hard to get short. It's hard to sell when you only have one contract to sell the close for your stop up here because it's going to be way more risk than you want. Well, if you're trading a stock or something where you can manipulate how many, change up your positions and how many shares you're trading, just have a default. That's one thing I do. I have a default number of, at this moment, just default number of shares because I'm primarily trading a bunch of stocks right now. And more of just taking little pieces in a couple of different markets. But have a default size where you just, you look at this chart and you say, oh, well, we've had, however many bear bars in a row. I'm just going to sell this close, put my stop up here, and trade small enough to where if you walked away and got stopped out, it would not be that much more than a normal size. As opposed to, even if you were trading down here, if you sold the close down here and put your stop up here, well, make it to where it's a normal position size. The worst thing you can do is your normal risk is, just out of curiosity, this is about $213 to $212. That's about $1.10. So if you're trading if you're trading a normal position size of 20 mini contracts, roughly 500 shares, it's almost exact. So that would be your normal risk in the E-mini. If you sold this close and put your stop up here, you're risking $550. So if you got stopped out, hypothetically, which you probably would not, you're going to lose $550. But I think more importantly, or not more importantly, but what tends to mess people up more so than let me back up. The single thing that messes people up with trading small is they just don't do the right thing. And they know what the right thing is, but they're blinded by the risk. It's kind of like this. To give you an example, let's say you sell this close, stop up here, and you know that number one, you've probably seen the high of the day, and at the very least, we get a 50% pullback, and guess what? There's probably going to be sellers and a retest down. So in the back of your mind that if you sell down here, you can probably get out of break even. Well, here's what I don't want to say most people, but here's the risk of trading too heavy. Number one, you're uncomfortable with what you're doing, and number two, when you're right here, you think, okay, I'll put my stop up here, or up here, and you see this bull breakout, and you think, oh my gosh, if I get stopped out, I'm done. I can't lose $500. That's a lot of work, and that's a lot of money to lose at once. And they end up getting out, they panic and get out of their shorts, and only to watch it test all the way back down. As opposed to trading really small, that's why I think that's one of my issues with Always In. I think Always In is great under certain restrictions. I think Always In is a mistake. No. I want to restate that. Always In is a mistake if you're only trading one contract. I think you're far better off to trade Always In this approach. Here's how, if I could go back some number of time, I would start with Forex or stock, and I would just say, okay, here's how I would trade Always In short. I'd say, okay, Always In short, the risk is big. I'm going to go to half size. So, my advice, personally, if someone was starting out, I would trade 50 shares or 25 shares starting out online, or just starting out in general. And by doing that, your risk is tiny. You're gonna get killed by commission. You'll break even probably if you do well by commission. Anyways, I would just say, okay, I'm gonna trade a half position. I'll sell here, put my stop up here, and or whatever your half position is, it's gonna keep going down. I'm gonna say, okay, you know what? I've made a lot. I've made well more than one times my initial risk. I'll take half off, or whatever the number is. Or if your stop becomes too uncomfortable, you say, you know what, I'm just going to reduce my position size by half. Now, I get it, if you're only trading 25 shares, if you reduce it by half, you're only holding 12 shares. And you know, if you're trading that small, it's more of just to get the mechanic of it down. Obviously you're not going to make anything with 12 shares, but it becomes a difference when you're trading 200 shares. You take off part of the 100. So let's say you're trading. Let's say you sold 100 shares here, stop up here. You take half off. Now you're down 50 shares. Maybe your stop's up here, and then you just hold. Personally, I think it's okay to get out above, but if you didn't and you got out a part of your shares here, then you say, okay, decent pullback. We should probably test lower. Bad follow through. I'm gonna sell, and I'm gonna add my full position. So I was short 100 up here. I took part off, and I was short. Now I was short 50. I'm short 50. I'm going to sell another 50. Stop up here, and look to take profits halfway down. Then maybe you take you take 50 off again, and now your stop's probably up here. And then you get another bear breakout. Now you move your stop, so you're still short 50 shares. And you say, okay, this is getting climactic, but Al says that the bears need a major trend reversal, so I'm going to keep my stop all the way up here. And by the way, that's about 212 to that's about $1 risk. That's almost 10 points risk in E-mini. But regardless, the stop's up here, probably minor reversal if any. And I think it's okay to get out of shorts here, but let's say you didn't and your stop is way up here. You keep reducing your position, and it just keeps going down, and you move. At some point your stop is up here or up here, and price just keeps selling off, and it goes shorter, and maybe now your stop's here. At that point, probably always I'd get out of shorts and look to sell again. Theoretically, you got to get short below here, but hard to, that's tough to do. You can see, maybe 50% pullback, but if you're selling, stop's probably up here. And so, yeah, and I kind of want to take some of that. I want to talk a little bit about what I was talking about over here. One issue that's kind of just glancing as I'm going down. But one of the problems with, I want to slow down right there. Two things. Number one is sell climax, another sell climax. A lot of sell climaxes down late in the move. Haven't touched the moving average in a while, so reasonable to get out above here. And you've got, I'll talk about these two stop features in a second. So probably going to get a second leg up. Follow through, you don't sell below here. If you sell it here, your problem is it's 50% pullback almost. So plus it's late in the day, so it's not really great short. The next thing is you've got the issue of this is a reasonable buy. So whenever you get a reasonable buy, such as up here, traders will, even there wasn't enough. I don't know. Maybe they risk some crazy number. I think more importantly, the bulls who are buying above here are institutions, and they know that if they buy here and they use a stop, just that's ridiculous. How maybe it's all the way down here. I don't know. But what they do is they buy and they wait for a bull bar, and they add on here. If they're sufficiently disappointed, they'll get out of break even, which many did here, or they'll wait. And look what happened. So they bought above, bought more lower, made money. But anyways, if you do the math, I know you're thinking, well, gee, 50 shares, 100 shares, that's not a lot of money. Well, it's not. But if you can consistently be more, I was going to say consistently be more consistent. If you can become more consistent and do the right thing more often, the little pieces add up. Plus, when you're risking a lot, it's easy to miss these huge moves down. And let's do a number. Let's take a number. Let's take 100 shares. If I sell this 100 shares, or better yet, let's say let me back up. Let's say you're starting out 200 shares, and you sell this close at 12.51. You take profits at a measured move down at 12.04. So let's just say you take 50 cents off, just for simplistic sake. Obviously, 100 shares times 50 is $50. We know that. Just kind of using the calculator just so everyone's on the same page. So that's $50 on our first position, okay? And we're going to hold the second position until it's clearly not always in long, or not always in short. Okay, so we sold at 212.5. I know it was 212.51, but let's just make it simple. 212.5, we got out 1 or 2 ticks above at 209. Let's just say 95. Let's make sure that's right. Okay, yeah, so it's $255 plus the other 50. That's $305 on 200 shares. So, and that's only taking 200 shares. So, now let's talk about just one E-mini call. Let's pretend if you were trading one E-mini contract, maybe you took all your position off at 5 points and you made $250. Well, the problem is it's hard to get back short, especially when the risk is big, especially when you're nervous about the risk. So let's say instead of trading 100 and 200 shares, you're trading 500 and 250 shares. Or let's just say you start out with, let me restate that. Let's pretend that we're going to trade the equivalent of one E-mini contract in the spider. So that's 500 shares. We're going to sell 500 shares, and we're going to do the same thing. We're going to take half off, so 250 shares here, and swing the balance of the other 250, totaling 500 shares. Well, so 305 divided by 100. Hang on one second. That was 212.5. Okay, yeah, so sorry about this. So that was $2.55. So anyways, oops, there we go. So same thing as before. We're short 500 shares. Stop up here. We're going to take part off at 1 times our initial risk. So we're going to take half off at 0.5 or 50 cents. So half off at 50 cents. And half off for us is 250 shares at $125. We're going to swing the balance. And we know we made $2.55 from the second portion. So the first portion, we make 50 cents. We sell here, scalp out. Second portion, we're still short, and we get out above this bar. So, and the second portion is, we know we made $2.55 on 250 shares. That's $637 plus your first position of getting out at 50 cents. That's $762. Now, so here's my point and my proposition to everyone that's trading the E-mini on one contract. If you can manage to sell here consistently, sell around here and get out here, or sell here, get out here, but get back in and get out. If you can net 15 points on a day like today, or something around that, then hey, more power to you and keep doing what you're doing. But for most people, if you want to make it less stressful, lower your position size. Let's look at, I know there's plenty of people saying, well, gee, that's, I can't fund a $25,000 account. Okay, so let's look at the Euro USD, the Euro dollar, 5-minute chart. I think Forex is great. Let's just look at maybe here's 855. We see a bear bar, so we just say, okay, I just want to see something. Okay, so these bars are fairly big. They're all a little more than almost the size of 10 pips. So let's say we sell this close or sell this follow through, and we say, okay, Forex you can trade really, really small, and it's a lot cheaper to find an account starting out. So you just sell, stop up here, and you either take all off at a measure move down, or maybe you take part off at 10 or 20 pips and another part off at a measure move down. And, that's one trade locked in. Maybe you say, okay, probably always in long, I'm going to buy really small and put my stop down here. Maybe I'll buy more on a 50% pullback and take profits up here. And you can see that's exactly what happened. When I say exactly, traders take profits at the new high. And you're still long, though. That's the beauty of it. And you make a little bit. If you happen to be, I live in the U.S., so if you happen to be awake at 4:30 in the morning, you just sell. The problem, people miss these, I'll call them FOMO trades, fear of missing out trades, in the webinar, which I thought was kind of a neat term and a good way to put it. When you look at this chart, the first thing when I see this, I think, that shouldn't have happened. You have trap bulls. The bulls, they bought this close, scaled in lower, and they're getting out. And there's a moving average up here, but take the moving averages away. I don't need them. No one needs them. We think, that shouldn't have happened. If I sell this close, put my stop up here, I'll probably get a second leg down. Trade small, even scale in. And look what happens. It just keeps going down, and you move your stop. Just stay short. And if you would have stayed short, you take profits along the way. Sure, you make 616 to 556. Now I know, realistically, you might get out over here somewhere, but let's just say you only make 45 pips. Well, let's look at a pip calculator. So that's a standard lot of 100,000 units. Let's say we're just trading maybe 5,000 units, or let's say we traded 10,000 units. That's $1 per pip, okay? Well, from here to here, let's just say we make 45 pips. So that's $45. That's real money. And you know, when you look right here, you know it's going lower. So just sell, put your stop up here, and pinch your nose, as Al says, and it's kind of like you're jumping off a high dive, as he put it. Just hold short, hang on. Up here, always in long. Buy, stop down here, or maybe you say, well, gee, we probably need a major trend reversal, trend line break. So I'm gonna, I want to see what a 50% pullback looks like. Okay, well, then buy a 50% pullback. You see these tails, buyers below, so buy here, take profits here. That's what happened. And but regardless, stop down here. But again, I'll point out it's a minor reversal. I'll add this back since I know people like moving averages. I like them personally myself. Even it's kind of interesting is you can sell anywhere in here, put your stop up here, scale in higher, scalp out, strong enough breakout for at least a little more down. But this is a warning. Price will probably come back to this high. Bulls will buy here, and so let's say they buy, they put their stop up here, and they buy above, and they look to buy above a bull bar. And maybe probably not buy above there. And eventually they can just take profits. So it's almost 10 cents or 10 pips. But that's what traders do. So, just kind of a side note. Let me go back to the E-mini. I just like the E-mini more. Ooh, here's a good example. So, sell off, it's a 50% pullback roughly. Maybe it's a pullback from this rally is where I'm getting at. And you see this sell off and you think, it's weak looking, I think we're going to test back to the open. I think bulls will make money here. So what do? Well, a lot of traders, they'll just buy and use a wide stop. Just put their stop somewhere down here, betting the price will go up. If you buy up here, maybe you bought this high one. Well, your stop does not go below here. It goes below here. And if you didn't do that, you got stopped out. Even if you bought this high one, and you buy this high one, you buy this high one, stops down here. And if you bought it, you had the chance to make a little bit, but it's buying high. You're at the top of the trading range, 3 pushes up, 1, 2, 3. I wouldn't want to be long here. And that was the end of the day. So, here's another example. Let's pretend if you're trading the spider, you can trade small. You think, at this moment in the E-mini, 96, sorry, it's about 96 even to 91, so that's about 5 points risk. It's $250. The odds are high you'll get a measured move up. So, for most people, they're better off trading the spider. They can get long, take part off at a measured move, and just swing the balance, and maybe they get out over here. You see the market selling off here, just sell at the market, stop up here, maybe take part off, and here. So my best advice to give is trade small, and sorry about that. So just work on trading small. or having the ability to take partial profits. Alright, hope this video helps. Thanks.